please come in and take a seat. So we have our next panel is looking at fostering global liquidity using trust anchors. It's an excellent group led by Lawrence Vanderloo. Let's please welcome Lawrence and the panel to the stage.
Great. Good afternoon, everyone, and thanks for joining this panel. My name is Laurence Vanderloo. I spearhead the Tech and Ops initiatives at SIFMA, the region's capital markets trade association, and part of the GFMA. I'm very honored to basically have all the key stakeholders of Project Trident with me on stage. Project Trident was one of the announcements that were just presented to the public today. So on my far right, we have Alan from the MAS. We have then Anna Naomi from UBS, Fernando from SBI, Keith at DBS, and Ushida at the GFSA, the Japanese Financial Securities Regulator. So we at GFMA and SIFMA, we've been looking at tokenization since 2019, actually, and it's really exciting to see it all coming to life, see all the various actual pilot announcements today, and it's very encouraging to see the regulatory support as well. So I think the benefits by now are really well understood, but what is really needed to move the needle is wide participation. It's an entire ecosystem overhaul. We need to pool liquidity. We need regulatory clarity and harmonization, and we need interoperability. So as we talk perhaps in a little bit more detail through Project Trident today, we're going to discuss how Project Trident and the participants are advancing these various issues. So I think I saw some new faces coming in. So whilst we actually just covered Trident in a bit more detail during the announcement in the previous session, perhaps Fernando, if you could, perhaps in a high level way, perhaps present Project Trident and what you guys did.
Absolutely, and I will keep it high level because Keith, Anna, one of my guys in GSOD was pretty hardcore, pretty technical, and I don't even quite understand it myself, to be completely honest. But in a nutshell, it was the first ever live repo transaction using tokenized securities and using a stablecoin as the settlement method or mechanism. And one of the beauties of what we did is that we did all of that cross-border. So the potential of blockchain and LGT technology is that we should be able to create an actual global capital market ecosystem. So being able to do all of these cross-border end-to-end is kind of a prerequisite. Where we do issue this, within Switzerland, within Japan, and be able only to trade that within that country is a bit meaningless. And beyond that, I see that we have the word liquidity in the title of this session, but I would argue that we need to solve the mobility issue first. Actually, that was quite a challenge initially, because one could argue that in Switzerland, legislation is more mature. You can issue securities in a natively tokenized format, but that's not necessarily the case in Japan, right? So we had to come up with a certain degree of regulatory wrappers, and we had to come up with a set of risk controls that wouldn't be required if there were more regulatory alignment between Japan, Singapore, and Switzerland. So again, it was super successful. We had to prove the limitations of the current regulatory regime, but for this to scale, we need to do more work on the mobility side. For me, it was one of the learnings. Another was mentioned by Keith in the previous session, was the redemption of the stable coins. The redemption is one thing, but mobility is also the key issue that we need to address. And for that, again, I don't want to put words on the mouth of my two regulators. I will be in trouble otherwise. But getting...
I can do that.
Thank you. I think what came clear to us is what the problems are. I think we can get it done, and the redemption issues, and there is the fact that without more regulatory alignment, we cannot do this at a scale.
Before we dive deeper into the remaining challenges, perhaps, Anna Naomi, can you perhaps explain why the specific use case was chosen? What are really the problems it was trying to resolve? Because actually for a non-repo expert like me who was looking at the slides earlier, it actually looked pretty complicated to me. So how is this simplifying things, and why was this particular use case chosen?
Yeah, I think we had certain cornerstones we wanted to use. So it should be a digital native security, which had to be under Swiss law because only the Swiss law allows at the moment for digital native created securities. Then we wanted to do a trilateral transaction, so we had to combine this because the bond issuance usually goes to one investor, so it's bilateral. So we kind of figured that we need a repo transaction in order to finance that bond purchase. So that bond purchase of the digitally native security. So and this digitally native securities was then used to repo out to the third bank. And on the other hand, it should also be purchased in a digitally way. And since it is a cross-border transaction, we have different legal systems. And actually, Fernando mentioned it already. It was a stablecoin, but it was a regulated stablecoin. So it was a regulated stablecoin under Japanese law. So we had to, in order to get the proceeds of our bond, which we have issued, we had to accept a Japanese law stablecoin, which was sent to us on chain. So all assets and liabilities of this transaction were fully on chain, which is, I think, pretty spectacular. And then also at the end of the transaction, the repayment of the bond was again on chain. So it was done through a tokenized deposit. And so we didn't repay the bond with US dollar or Japanese yen. We repaid it with a tokenized deposit.
Great, thanks. Keith, I was just going to, over to you.
I'm going to add to that. So I think Fernando and Anna have covered the complex cross-border and the jurisdictional elements of it. But if you look at a repo transaction, and I'm picking up your statement where you thought the diagram or the diagrammatic representation on screen was complex, if you strip that out and you go back to a repo transaction as it occurs today, it's far more complex. I'll spend just a minute or maybe two just talking through a repo transaction. Once two banks or two counterparties trade a repo with each other, you've got to send a set of instructions to your Nostro or your cash correspondent bank to make that payment to the custodian, not the cash correspondent bank of your trading counterparty, in order to accommodate DVP. Upon citing of these funds, they release the securities, and the securities are then bound for your custodian, who in turn sends you a notification saying that the securities have been received, assuming that you're doing a reverse repo transaction. In turn, once those funds are received by the custodian, and the custodian may not always be a bank, may not always be a cash bank. It could be a pure custodian, which means in turn it's instructing its cash bank to make the payment to the cash bank of the receiving counterparty. And if we had to show that diagram on screen, it would probably take 2 slides. So what we've achieved, apart from the cross-border and the technology and the sort of simplification of this, is also a simplification of a repo in today's trading environment, in today's world. Most repos, look, you can do a repo today or a reverse repo and it will settle on T0, but that's not the norm. You need time and you need to cater to funds, pre-funding upfront in order to be able to accommodate this transaction. That's in a nutshell, just to give you a sense of how complex a repo transaction is today.
Great. I'm going to stick with you, actually. Fernando touched on some of the remaining challenges, including mobility. Can you perhaps dive a little bit deeper into those, and then I'll turn over to Ushida.
So I think in terms of the transaction, we've come a long way. We've crossed borders, we've crossed jurisdictions, and maybe we took a fungible currency. So that really sort of brings us a long way. Japan and Singapore are 1 hour apart, but between the two of us in Switzerland, that's a good 6 to 7 hours away. They're right now. From that point of view, I think orchestrating this and achieving DVP and a full settlement. Bear in mind that this wasn't just, what Anna mentioned, it wasn't just a repo transaction. It was the issuance of a bond by UBS and then a subsequent orchestration of a repo transaction between DBS and SBI, and this all took place within a few seconds or maybe a few minutes, all on the same day. So that I think is a big achievement. We've done a yen transaction, we've done a bond issuance, we've done a repo. Again, Anna mentioned a stable coin under Japanese law on the way in, and a tokenized deposit on the way out. So that's I think where we got to give ourselves full credit. On taking maybe one step back or one step down, digital cash in stable coin format can be used, but we chose to have this redeemed for cash, and rather than carry this on our books, against which on both the legs, the front leg and the far leg, both the parties chose to redeem the stable coin initially and the tokenized deposit for cash. So maybe that's a leg that we need to think about. Again, I don't think that the solutions are being worked on as we speak, but it also proves to some extent that we are able to marry the old world and the new world. The new world being completely digital, the old world being, if we still need cash redemption, which needs to be married to or tied into the leg for redemption, for cash redemption, that's entirely possible. Again, that's where we'll have to pay attention to time zones, central bank cutoffs, correspondent bank cutoff, clearing times, pre-funding, etc. But it also proves that a completely digital transaction can be intersected with a cash transaction.
Great, thanks. Ryo, I'm going to turn over to you. I understand this was the first transaction under the Japanese Stablecoin Act. What are, from your perspective, some of the key findings, lessons learned from this particular first transaction?
Sure. So Japan has just implemented the stablecoin regulation June this year. So this pilot was conducted immediately after this amendment. And then to be sure, stablecoin under the Japanese law is different from tokenized deposit in that stablecoin is not linked to banking deposit. Having said that, stablecoin can be issued by banks or payment service providers or trust companies in a number of ways. And then, as for this project, to be precise, so stablecoin issued by SBI are exempted from Japanese regulation because this pilot is just a one shot of transactions and it's not a recurring business. So we decided that so SBI do not need a specific registration license out of this project. But having said that, our regulatory colleagues, supervisory colleagues, and then SBI had a number of discussions, and then we make sure that this is totally in line with Japanese regulations. So we are very glad that stablecoin can be issued in Japan and then to be used for this very innovative project.
Alan, I'm going to turn over to you now. So one of the announcements of the last couple of days and weeks was the setup of the Guardian Policy Makers Forum. Can you perhaps talk us a little bit through that? Like what's the goal, the objectives, and what are some perhaps concrete next steps of that forum? And we understand the IMF just joined as well, which is great.
Maybe just a terminology just for the audience, because we mentioned Trident and Guardian, so maybe just to bridge it a bit. So I guess Project Guardian is this initiative that we started. It's made up of different pilots. But I think one of the key focus areas that we've had the opportunity to work, I guess, with the group here is this specific area, which Trident, as you can imagine, why. So just to draw the bridge. Back to the original question from Lawrence. So when we started, I guess, Project Guardian, the way that we look at it is really, we can only learn so much, whether we are a financial institution ourselves or as a regulator. We can learn so much better if we see this in action and we actually learn from others. So very glad and very happy to have our fellow policymakers, the Japan FSA, be on board, Ushida-san and the team. So I think with that, I think it's really a learning process in my view, and helping us to build muscles, build capacity on both sides. And I think that's also a feedback loop as well. How do we better inform how we go forward in developing our policies that will be better fit for the needs of the digital asset economy.
And Rio, I think you were the first, GFSA was the first regulator joining this policy forum. What was the rationale behind it? What are you hoping to get out of it?
Sure. So it was, I think, a couple of months ago when Alang and Sofnem invited FSA to join this Project Guardian as an observer. So I found it quite interesting because it's exchange opportunities for learning by doing something. Even though we are just observer, but we are joining a monthly discussion with private sector practitioners, and then we learned how it is difficult to make a tri-party contract on the digital asset, and then we learned some technological insight out of that actual transactions. So we have no intention to kind of endorse specific companies, a specific project, a specific public blockchain. So we don't mean Ethereum is much better as a public blockchain. So that's just great learning opportunities for us. And then going forward, we believe tokenization is the future of the banking sector and the financial sector. So but at the same time, there is risks, like liquidity risk and liquidity risks and operational risks. So it's better to understand the risks first and then to think about how to mitigate the risks to strike a balance between innovation and risk mitigation.
Maybe one comment. The GFSA be my main regulator. Hadn't they joined Project Guardian this year, I will have had to change my commercial roadmap and focus on other jurisdictions, to be honest. Like for us, the fact that you guys somehow managed to work together, it really made a huge difference, right? So we've been focusing our efforts in operationalizing what we call the Japan-Singapore corridor. Of course, still need to get the rubber stamp from these two gentlemen, but hadn't this happened, it wouldn't have been Japan-Singapore corridor. It would have been Singapore and some other jurisdiction.
So some of you may have impression that Japan is conservative, and then Japan is not very open to the international kind of business, but we try to change such reputation. We are open to any type of business as long as it is in compliance with our regulation, and then we try to be kind of having a more engagement with a variety types of international experts like these guys. So that's a great opportunity.
Yeah, I'll just add to that. So I think from our point of view, we're very grateful to have the MAS along, partnering with us and walking with us on this journey. But just on a general point, we are headed into uncharted waters. Every day we have sort of new experiments bringing about efficiency in technology, efficiency in settlement, efficiency in the back office, introducing new products, etc. We've talked about at different forums, including this, we've talked about a public-private partnership. It's very helpful, with due respect to the comments made by the JFSA. I don't think it represents an endorsement of any one company or any one project, but there's learnings to be had on both sides. As we head into this new world and we develop regulation around that, the regulators themselves would have first-hand experience of what it takes, both from a product life cycle, from a regulatory point of view, etc., rather than let the private enterprise go ahead, do what they have to do, and then come in at a later stage with no understanding or no proper understanding of what it takes. So the point I'm trying to make is around the public-private partnership. This is not meant to be seeking for an endorsement or a leg up for any one institution. It's meant to work together. We learn from each other, And then when the code is developed, whether it's a regulatory code or a technology code, it's not too far away from the general consonants in terms of what the private enterprise is in need of. But at the same time, when they understand the risks, they're able to put in those necessary boundaries and barriers to protect the general public, maybe the retail sector, understand the risk a little bit better. The point I'm just trying to bring to the fore is it tends to be a very successful public-private partnership, and we both come away a little bit richer from the transaction.
I've looked at something that I've seen since I started this journey with the Project Guardian, which is the fact that I think the private sector can play a really big role when it comes to getting regulatory alignment between different jurisdictions. There's been a number of unnamed regulators in, let's say, the APAC region that reached out to me because they wanted to know more about Project Guardian. But maybe that particular regulator might see the MAS or GFSA as a competing regulator. So, again, I cannot disclose the names, but I do honestly think that we as the private sector, we have a responsibility, right, to be the bridge between jurisdictions that on paper at least, right, taking the context geopolitics are kind of competing with each other, right, but at the end of the day, with the private sector, and if there is a business case, I think we should facilitate that kind of conversation. And I think that quite often for the last year.
Since everyone is jumping in, I'll jump in as well. So I think the way that we constructed this really is a question of, is there a competition between jurisdiction and use cases? So I think that's one of the key principles within Project Guardian was really we lose more by not collaborating with each other. So I think that's the approach that we are taking. And to be honest, there's only so much we can do in Singapore by ourselves. So we learn better by connecting across borders. And to this point, really welcome more institutions, more policymakers, more jurisdiction, and let's really make this a global liquidity, right? So I think that's where we want to take this. So no competition.
Yeah. Thank you. No, I'll add on to that point. We've throughout this forum, previous forums, we've talked about harmonization of and high costs. These high costs tend to occur simply because you have disharmony, and you've got to cater to these different regulatory standards. Now, I want to be clear. I don't think we'll ever achieve perfect harmonization, but having the 2 or 3 regulatory authorities work together, I think that brings some form of uniformity. Again, we'll never get a perfect, but it'll help towards smoother, more efficient cross-border transactions and lower costs that we've spoken about throughout the day.
Yeah, and maybe to add to this, so we didn't build a basic network for this. I mean, we used public blockchain, Ethereum, and every of these 3 institutions was very simple to plug in. So no one had to build a lot. And then the next question is this safe? And that's kind of always triggered. And I think the safeness of this transaction comes from the smart contract level governance. So through this, we ensured that with whitelisting mechanisms and variable credentials, this comes into a very safe and compliant transaction. So we did this whole transaction under existing laws. So all enacted fully existing laws. And I think that's quite special about it.
Great. Alan, you touched on liquidity, so we'll talk a little bit about that. But before I do, just wanted to let the audience know we will take questions. So please prepare, and there will be handheld mics over to you in a second. But talking about liquidity, the question that I was asking myself is that will this not fragment liquidity away from the traditional fixed income and repo markets? And how can liquidity be pooled? How can it be bridged, etc.? What's the thinking and perhaps some of the initiatives undertaken? And Keith, you want to take that one? Yeah.
I'll start with that and hand over to whoever picks up the baton. So Specifically, as far as this transaction was concerned, was effectively a transaction in a laboratory, very controlled, tightly from a technology point of view, from a regulatory point of view, and from a technical point of view. We made sure we cleared accounting and finance in advance, and my counterparts at both UBS and SPI had to do the same. So the experiment itself was very tightly controlled. But from a liquidity point of view, it's no different from what you do today. It's not a transaction which is unheard of. It's a bond issuance by UBS. So effectively, it's corporate credit. It's a repo transaction. Repo probably is the biggest, or if not the second biggest, second only to FX maybe. But in terms of volume per currency, repo is probably the world's biggest transaction. Overnight volumes on SOFR is about 1.5 trillion. So daily, that's daily. So it's no different from what happens today. So in my opinion, it doesn't lead to any further fragmentation or fracturing of existing liquidity pools. If anything at all, it contributes to them, because we're not using a new product, when you are not using something that's radically different and leads to segregation in the different pools or isolation of pools of liquidity. It brings together and continues an existing trend. So when I think about it, when I think about a bond issuance and I think about a repo, that coupled with the settlement, which partially involves today's networks, I actually think that it contributes to liquidity, both to liquidity of the product and liquidity in trading markets in terms of volumes for the transaction that we've just accomplished.
Any complementary or additional views?
Yeah, one comment. I think before realizing the full potential of blockchain, we need to deal with certain legal issues. I'll give an example. SBI itself, we have an MTN program, but we only raise capital from inside Japan, because doing so in other jurisdictions, it is pretty painful. So we can't even start discussing the whole blockchain thing. We need to make sure that even on the TradFi side, there is more regulatory alignment. That's not the case today, and Anna can tell you much more about that than I can. But once we get that sorted out, I do think that this technology, the approach that we've taken, can be a game changer, because it can bring, as Keith pointed out, operational efficiencies that were not there before. But before we get there, in some cases, there are some legal hurdles that we need to work on.
Alan, sorry, Naomi, Anna.
Yeah, maybe add one point. I think standards are important, and we used also certain standards. So for the smart contract, for example, we used the CMTAT, which is a standard for a smart contract. We got it audited for the changes we had to make to it, or additions. But this was a very good experiment, because it was easy for us to deploy, but also easy for the others to receive. And I think that's at least a step in the right direction.
Alan, any comments from you on the liquidity side of things?
So I guess we need to look at perhaps different asset classes and what we're trying to achieve. So there's a conversation around fixed income, or something that perhaps is less liquid by nature. Stable, let's say less volatile, but less liquid. So is there a way by tokenization to facilitate that liquidity in that sense? And the other piece is just on this idea of the existing mechanisms for maybe FX trade, whether it's on the OTC basis, you need to have bilateral counterparty lines set up, and whether there's an alternative way to pull this together, to Keith's point about fragmentation. So I think that's a few other themes that we are looking at when we speak about liquidity. It's pulling existing ways of how trade is done, and the other thing is the asset itself, whether we can have the ability to have assets that are made more liquid and tradable.
Do you want to add, Keith?
I will. So I think from an FX or any trade settlement point of view, every trade is pre-funded. The question is whether you cough up that money up front, or whether the correspondent bank does it for you through intraday lines. I think one of the things that sort of distorts today's picture, not in a bad way, but one of the things that distorts today's picture is your correspondent bank giving you an intraday line. You probably think that your trade is settling without pre-funding. That's not the case. It is your dollar bank, your yen bank, your Sing bank, etc., providing this liquidity for you. So the concept of pre-funding is not going to go away. If you need your trade to settle, whether it's a DVP trade or not a DVP trade, funding will be required. The question is, how do we cater to this funding? Again, the technology, and Fernando's made reference to this in the recent past, whether we do it in terms of just-in-time funding, whether your correspondent bank provides it for you, or whether you seek to do it through other means of funding, including a technology element to it. That element, from a trading point of view, is not going to go away simply because it brings risk and settlement risk with it. So that cannot be eliminated. The point we'll have to think through in far greater detail from today is, if indeed with the launch of different products, not this, where pools are fragmented, we'll have to start pulling it together once again for better settlement, lesser failed trades, etc.
So let me, I'm more clear on what Keith and the others just said. I think now we're at the moment where we have the technology that, at least on paper, should allow us to do global distribution and global origination. The tech is there. So the problem now is more on the regulatory side. It's not just about the sell side. It's mostly banks on this side of the table or this side of the room. I think the buy side should be represented here. They're going to have their own challenges. So we have the tech, super cool. Maybe we on the sell side, we can structure the product and try to sell it. Is the buy side ready to be part of this? I don't have the answer. So we have the tech. I think we have the set of product. I think it's going to take, but I think we are missing some of the stakeholders in this room.
Maybe there are some buy side in the room that have some questions or comments. I know this is the technology stage, but we will take questions and comments through in the old-fashioned way through handheld mics. So, are there any questions or comments from the audience? I have plenty more for the panelists, but I wanted to check, and I think the SFF staff can bring a handheld mic to you. No. No comment. Yeah, there's one question in the back, please. Yeah. Mic is not working.
Hello, can you hear me? Yes. What was the most challenging element in these transactions? And was there any surprise that something that you believed first would be complicated and you realized that it was easy?
Well, I think the most complicated aspect in the transaction was definitely the payment leg, as we called it, to figure out under different jurisdictions to accept it as means of payment, I think in every direction, and also at what extent we want to do the settlement then of the transaction on-chain or off-chain. So our goal, and I think we managed to reach that, was to have the full transaction fully on-chain. So every aspect. And I think that was, to really keep that, that was the biggest challenge.
So for us, the biggest challenge was the fact that the Stablecoin Act was enacted in June. And we started to work on this project a week before the law itself was enacted. So we were super cautious, Ushida-san, just to let you know, not only with you guys, but also with the internal stakeholders within SBI Group. Because we needed a trust bank within SBI, we needed a broker-dealer to work with us. And my pitch was, let's do this thing. It's going to bring more liquidity to the market. By the way, it's not regulated yet. No one has done it before, but it's going to be fine. I did have a strong pitch, to be honest. So I need to thank the JFSA and MAS for putting a work for us. And it also helped the fact that last year we did this, JP Morgan and also TVS. So we did have a track record. But even with that, it was quite a challenge, right? So it took us a while to get all the internal approvals. So I need to apologize to Anna and Keith for keeping you waiting for, certain signatures, but it was not personal. But that aside, now after all this pain, all these stakeholders within the SBI group, they understand the potential of this technology. So they are finally fully committed. So that pain that we went through was worth it.
Regulators first.
Just one thing. So I'm in charge of FinTech and innovation policy, so I'm not directly in charge of the supervision and the licensing thing of a stablecoin business. So my personal challenge is to stand between, players, SBI, and then my supervisory colleagues. So it's just after the implementation, so they are still kind of considering conservatively how we should approve this kind of stablecoin business. So I try to facilitate a discussion between two parties, and the ultimate decision was done by supervisory bureaus, but the result is as we discussed. So that's good outcomes.
I would say some of the smaller operational, more technical issues which we did not pay attention to when we focused on the bigger picture, the transaction itself, the legal elements, the different legal agreements that we had in place. Again, not to say that they were not fraught with complexity and didn't have their own issues, they did. But internal dialogues certainly within our organization, and I'm sure within SBI and UBS, you got to speak to your finance and accounting teams. You got to have your daily mark-to-market P&L. You got to have a discounting curve, and some of this is a little bit difficult because you've not done a digital transaction before and have a P&L reported against a digital bond. So some of those things were operationally cumbersome for us. And I would go sort of, even one step further to say something which we took for granted, putting ETH into the wallet to be able to pay for the gas fees, sort of tripped us up because we had a closed ecosystem. We had to fund the wallet. Again, not large in terms of value or volume, but just operational details within the firm, including small tedious things like finance and accounting and getting your ETH into the wallet to be able to make that payment. Again, not meaning to trivialize all the cross-border and the legal agreements, but there were other challenges within the organization as well.
There's another comment. I really want more of you to suffer, like we did. Otherwise, we won't be able to reach the critical mass that we need to make this happen. Honestly, I think that with us, the people in this room, we can get there. We can reach that critical mass. But that means that these people, as you said, that some of us already have gone through, you have to go through. There are no shortcuts, to be honest, right? But some of us are more than happy to be your partners in your, what I call, the entrepreneurship journey. So please suffer a bit for the better good. That's, for me, was one of the takeaways.
Yeah, and I think the whole technical side was actually relatively smoothly, and especially led by SBI. I have to say, that was, in my eyes, relatively complex from the outcome because everything was connected. So either everything would happen or nothing. So if the repo wouldn't happen, then the bond transaction doesn't happen, and that was technically connected, which is, quite impressive. And as Keith mentioned before, but also brought this simplicity and which we reached through this transaction.
Simplicity, but also a challenge, right? Because it's not easy to explain to your board that is fine because it's a smart contract, right? And that's one of the reasons that we decided to work with the external auditors. We need a rubber stamp. Okay, at least my board is not that technical. It's not like you can walk them through the source code and explain what is fine, right? So that was also a challenge. But again, talking about stakeholders, having the buy side there is important, but having the big four, the big consultant firms getting more familiar with this is also going to help. It has with internal pitch, certainly.
And maybe another concrete example, again small, but given that this entire transaction was digital in nature from start to finish, we had to make sure that our middle and back office did not send SWIFT confirmations, both on the cash leg and the securities leg. So, we had to once you put this trade into your front office risk capture, your trading system, you've got to make sure that the middle office is not sending out SWIFT confirmations, just to make sure that the transaction is entirely digital, start to finish. So another small piece, but there were a lot of these pieces along the way that brought about small elements of pain.
Perhaps one more. Any more questions from the audience? Now is your chance to ask and then suffer less. Yeah, I see one more hand up. Thank you.
Hi. Just circling back to one of the discussion earlier about liquidity and specifically on the pre-funding that is something that is going to remain and not something you can solve on day one. And I think based on industry, there have been calls to whether can we reduce the cost of pre-funding. But on the other camp, there are people saying that especially in the high interest rate environments, with Fed paying like 5.4%, I don't mind parking funding. So, in your opinion, is pre-funding really an issue, or is it something more specific, like certain currencies have pre-funding costs, but for, let's say, the dollars, banks don't mind parking funds because they're getting like quite high yield in general?
Keith, perhaps? You want to take that?
So pre-funding is a given. It's required. In order to minimize your cost of pre-funding, there are tools available. You can do a bilateral netting or multilateral offsetting and reduce your pay-in schedules, etc. So in case you need to pay in $10 billion, if you're able to net it off against your counterparty and reduce the bilateral settlement risk or settlement, you can bring it down to $1 billion. The element of pre-funding is not going to go away. From a macroeconomic point of view, if you talk about interest rates, yes, different currencies will have different interest rates. At the moment, the dollars for a DM currency is probably the highest yielding. And it makes sense to leave the money at the Fed if you have an account at the Fed. If you don't, you're probably leaving your money at one of the dollar correspondent banks where you'll earn Fed effective plus or Fed effective minus, depending on how good your relationship is. But from that point of view, given that you're already taking on credit risk with your dollar correspondent bank or your euro correspondent bank or your yen correspondent bank, where you don't want to maintain anything given that rates in yen are negative, you'd probably want to put that out and earn something a little bit more if it affords you the opportunity to earn something more. That's basically the interbank market. If Bank A is short funds, you have funds at the Fed at which you're earning let's say Fed effective, but they are willing to pay you Fed effective plus 50, you certainly will do that trade. It comes with credit risk, but that's the way liquidity moves. It moves at a price.
Okay. We are slowly but surely running out of time. So before we close, I actually wanted to ask all of you in 30 seconds. When I was listening to the various keynotes and sessions at the plenary, at the festival stage this morning, there were a couple of buzzwords that kept coming back. And I will list these for you, and I will give you 30 seconds each to choose one and explain how you think this particular project, Trident, or Guardian more broadly, contributes to these. So the buzzwords were simplification, personalization, democratization, do good, and trust. I'll start to my right. 30 seconds.
Sure, so I will choose the good. So I think public blockchain can be used for good. So this pilot kind of shows the kind of potential of those. So I'm a big fan of open source innovation, but that does not necessarily fit the regulatory requirement, but thanks to the experts who has much knowledge about traditional banking compliance, we could have a good outcomes like this. So we are very much looking forward to the further development.
They're good. Keith?
I would choose simplification and the ability to work with our eminent partners.
Simplification. And here I would like to say that DLT and blockchain is not about disruption. It's not a revolution in finance. It's the next step in the digitalization of capital markets. This has been going on since the 60s. It started with mainframes. Then we have the internet, cloud computing, you name it. So this is the next iteration. And as we digitalize more and more of the value chain, we've seen the operational risk go down and have a more healthy financial ecosystem. So I think, simplicity is going to reduce the operational risk.
Yeah, I agree to this. I would also choose simplicity. I mean, the fact is we had 9 smart contracts, 3 factories, 3 assets, so financial assets, and 1 trade.
I will choose trust because...
I was hoping for that.
just to break the ice. Mainly because this project, unlike many other digital asset projects, is not trying to take trust out of the system, but to put trust back into the system. So I think that's quite a powerful concept.
Time's up. So please, can I ask you to put your hands together for the panelists? And thank you so much for your honest sharing. Thank you.